A risk-off reality. Big banks adjusting to a hawkish Fed raising rates. Concerns grow in a souring market about an economic slowdown as well. Banks this week were taken to task during a Senate Banking Committee hearing over their use of Zelle and their co-ownership of that service. And so we've been watching that. On the flip side, fintechs seeing a reprieve, and brokerages really seeing a reprieve in the SEC's decision not to ban payment for order flow. In other words, there's a lot going on when it comes to the financials. Devin Ryan is with us now, Director of FinTech Research at JMP Securities, a Citizens company. Devin, it's always good to catch up with you. So give us sort of the big picture here as we look at what's going on with financials. Because, yes, rates going higher, traditionally seen as a good thing. But on the other hand, if it's coming with a recession, maybe not.
Exactly. Good morning, Julie. So, I think right now the whole market is focused on the macro outlook, what's going to happen with the economy as a result of tighter financial conditions and higher interest rates. And so that's creating a lot of gyrations through not just equities, but all risk assets and all market prices. And so, financials are really, I think, at the center of the economic outlook. When people feel good about the economy, financials tend to do well. When people are nervous, financials are not really a defensive area. And so you're seeing that play through, I think, in the stocks right now. And no doubt there's some negative news and uncertainty in the market. But I would maybe take a step back and just talk about, what is happening longer term with these business models and also where are they trading from a valuation perspective. And so our view is that over the long term, higher rates will be positive. You have to work through some of the near term uncertainty, but earnings power actually goes up in a higher rate environment, and we think that will happen here again once financial markets stabilize, and we think they will. And then the second point is where we're already pricing these stocks. So this isn't the beginning of the sell-off. They're already down for the most part on the big bank side, 25 to 30% from their highs. Generally, in a recessionary backdrop, that's about where they go. They may go down a bit more than that, and so that's kind of our view that there might be some more downside here. But you've already priced in a pretty negative outlook, and financials on a PE basis, on forward PE, are trading at about 60% of the S&P 500. That historically averages around 80%. So you do have some value here, but at the same time, we do think you need to work through a little bit of this negativity in the market and also just get to a better consensus around where the economy is going. But longer term here, there are going to be opportunities. So I think people need to kind of keep cool heads in a tough backdrop.
Devin, we're only about 1 week away from the beginning of the fourth quarter of 2022. And then 2 weeks after that, we're going to start to get some bank earnings rolling in. What do you expect the tone or the tenor of the big bank executives to be, as they're going to be essentially setting the tone for the rest of earnings season, perhaps?
Yeah, it's a great question. I think it's important. So they have more visibility than we do from the outside. But I think, from everybody's perspective, there's a lot of uncertainty. There's a lot of I would say very smart people that have very differing opinions around what the market backdrop and the economy is going to look like over the next 12 to 18 months. And so that's a tough environment to strategically make big moves into. It's a big, tough environment to invest into. And that's the backdrop. But what I would say is that the actual business models are very resilient and have a lot of natural hedges. So we're doing some early work on firms like Goldman Sachs and Morgan Stanley heading into earnings. And the reality is that numbers are probably in a pretty good spot because on one hand, investment banking is very challenged and equity markets as of right now are down slightly on the quarter. The flip side is trading is actually doing better than I think most people have thought because some of this volatility has helped drive some activity there. So there's a lot of natural hedges. And so earnings power, in our opinion, is being affected much less than the volatility in the stocks. And so that's where over the long term, you get opportunities. But in the near term, when sentiment's negative, again, financials are not a defensive sector. So that's how positioning is at the moment. But that'll change, in our opinion. And that's where I think people that have a longer term horizon can actually selectively look at opportunities here.
Devin, you and I emailed about this next topic a little bit yesterday, and this is a little bit of a sidebar, but I do want to ask you about the payment for order flow story yesterday. Just a report for now that the SEC is going to stop short of banning payment for order flow. This has been sort of an overhang for the likes of Robinhood. The stock initially bounced, but then it closed lower. I don't know. How are you thinking about that issue and the effect that we saw on the stock?
Sure. Well, I think yesterday, the whole market was under a lot of pressure. And so you saw the fintechs take a pretty hard hit again. And I think that was really kind of what happened with the stock is you had kind of this initial, positive reaction. And really the headline is a modest positive is the way I would frame it. Payment for order flow is about 9% of Robinhood's revenues when you look at just on the equity side. And that's really where a lot of this debate is. And so it is a modest positive headline. I think it makes a lot of sense. We've been arguing that if the SEC outright bans payment for order flow, that will actually help larger firms like Robinhood and Schwab. And we could get into that, but it'll disadvantage disruptors and firms that are trying to get into the industry and take market share. And so what this does is I think the SEC is still going to look for ways to increase liquidity, provide more transparency, and improve execution. I think those are all great things that should be applauded here. But the way to do that isn't taking away payment for order flow. And so I think, again, modest positive, but right now the market's so focused on what's happening today and tomorrow in this really tough backdrop. And so that's, I think why you've seen, pressure on Robinhood and some of the other fintechs that are interconnected to that.
Devin, good to see you. Thanks so much for joining us. Devin Ryan, Director of FinTech Research at JMP Securities, a Citizens company. Thank you.